Mike, what do you do here? Do you think the Russell thing is a head fake?
I think I don't think it's a head fake, but I also don't think it's necessarily a straight line from here. The markets overall have become highly concentrated, both by individual name and by sector. They're extremely cap weighted, and that reflects a lot of the phenomenal attributes of these platform tech companies. But as so much investor emphasis has been focused there, it's created opportunities elsewhere, such that it makes sense for people to be looking elsewhere for value opportunities.
Like elsewhere, I mean, so you have some names, kind of energy, utilities, and so forth. But what's the fundamental case that even those who say, okay, a Trump administration, but you go back and you look at the performance of some of these areas during those 4 years, it's not always clear there was a massive opportunity there.
Yeah, I don't know that the opportunity so much outside of the big tech companies is really about Trump. And a Trump administration and what that means for economy. I think it's more just that they've been underinvested in as money flows have gone into index mimicking portfolios, and as these great companies have risen so much, capital has just become so concentrated, right? I mean, the top three names in the S&P 500 are over 20% of the market. So any opportunity to lighten up on those and look elsewhere, given the small size of the names we're talking about elsewhere. Again, I think the stat you just referenced, right, that the Russell 3000 is smaller than any one of those companies. A small amount of money moving out of mega cap companies can really have profound effects on these smaller cap companies. And you combine that sort of trading dynamic or tactical dynamic with attractive valuations in some areas of the market, and it's a pretty attractive setup on a risk-adjusted basis.
Speaking of looking elsewhere, I'm going to take a chance here and ask you about Comcast, which you like. It's down 8% year to date. Of course, we love it like family here since CNBC is owned by Comcast. But explain to me where you see the opportunity, especially given the challenge across both broadband and with cord cutting in general, with a consumer that seems to be pinched and looking for ways to pull back and spend less.
Yes, so Comcast has a number of phenomenal businesses, most notably, obviously, CNBC and its terrific talent. But really, what makes Comcast so attractive right now is a combination of attractive franchises, and most importantly is its high-speed data business, right? It's broadband connectivity, which is over half the company. And I'll come back to that in a second. The valuation is extremely attractive. Comcast is trading at about 10 times earnings. It's a strong free cash flow generator, so it's about a 10% free cash flow yield. You're getting a 3% dividend, which is growing nicely, and the remainder of the free cash flow is going to share buyback, which is shrinking the float, which is highly accretive to returns and earnings growth when it's done at such low levels. And the main concern around broadband and Comcast is broadband growth and subscriber growth. And there have been two dynamics weighing on broadband subscriber growth over the last couple of years, which we think are about to inflect the other way. So the first would be move activity. Obviously, with higher interest rates, we've seen less people moving and buying homes, and that's created fewer what the industry calls jump balls, which is opportunities for Comcast to compete to get new subscribers. With interest rates coming down, we expect more move activity, which should increase the opportunity for those jump balls. The second area for Comcast, and the broadband providers, which has been a challenge, has been fixed wireless access. And so obviously the wireless companies, Verizon, AT&T, and T-Mobile, have been offering fixed wireless internet as a competing product to broadband. They just launched it a couple years ago, and it had nice growth from its start. We think, though, that it's about to inflect towards slower growth, and really for two reasons. Number one, simply from a comparison perspective, the base of subscribers for fixed wireless has gotten bigger, so the growth rate will be lower. And then the second aspect is just that by its nature, it's limited in how big you can offer it. It uses a lot of bandwidth,
right.
And so there's natural constraints to how, spectrum, and there's natural constraints to how big that can grow. So as we sit here today, we see actually Comcast continues to have very nice pricing power in its broadband business. They're raising prices despite the fact that subscriber growth is weak. We think subscriber growth is about to inflect. Maybe not hugely so, but at least stop getting worse.
Right.
And you have a stock that's trading at 10% free cash flow yield when the market's over 20 times earnings. And we think it's just, we see very little downside and very meaningful upside when the subscriber trend improves.